Rohr here with a very concise highlight early on November 6th, 2014. It's currently 6:30 Thursday morning U.S. Central Time. And we're going to be so concise today because the markets are significantly conforming to the analysis of our global view from Wednesday morning, post-U.S. election assessment, and in fact, even the discussions on Wednesday afternoon from presumed future Senate Majority Leader McConnell and President Obama were accommodative, but not very specific. So it's left a good tone, friendly equities, friendly dollar, but really not much weight on the govies. And we'll be revisiting all that in a little bit. So, what does all this mean to the markets? Well, yesterday, in the wake of the U.S. election results with significant gains for the Republicans that, of course, we had expected on the back of the rather abysmal performance of the Obama administration and the degree to which the Democrats who were running were vulnerable because they were running in many cases in what were conservative states had been swept into office 6 years ago on the coattails of Mr. Obama's initial presidential election victory. So we were not surprised to see nervousness in front of the election on Tuesday, but not by very much, and of course not maintaining the temporary down break from late Tuesday we'd pointed out yesterday in the 2007.5 area. And then gapping up yesterday, maintaining the bid. And of course, here as well, we weren't surprised it was rather quiet and choppy out into after lunch because Mr. McConnell was speaking at 1 o'clock yesterday afternoon U.S. time, and the president was speaking at right around 2 o'clock. And again, both of them sounding more generally accommodative without getting into how they would approach individual programs or reforms was very interesting. And ultimately, this market can be considered to be underperforming in a way on a couple of fronts. As we've noted on the longer term, the intermediate term charts, the next oscillator resistance is not until up around the 2045 area, and the topping line is about 2055. Each of them move up about $5 out of this week into next. And of course, a market that's gotten through its old high at 2013.5, that's the old lead contract high. The December high is represented by this Fibonacci level here, 2012.5. Both as we look at what occurred on Monday and going out to yesterday, it hasn't gone very far. And in fact, December S&P 500 is back to 2013 this morning, and therefore hanging around that old high from back in September. Now, again, even if it should dip, the 2007.5 area will be pretty good support initially. There still is further gap support down into the 1996 to 93 area, so it's not like it would be that bearish. But the bigger supports revert back to the old July high around 1985 and the much heavier congestion into the 1975 to 78 area. And the other level on which this market is not that impressive is after rebounding this far from Tuesday's early low, we can see where the hourly MACD is not yet out above its runaway band yet. So it's exposed as opposed to the weakness we're seeing this morning. This market would need quite a bit more strength to look like it was really ready to push up toward those more extended resistance levels. And that pretty much does it for the short-term view of the S&P.